this weekend felt a lot like 1010 in a lot of ways, where you just had this massive leverage unwind, regardless of what the actual trigger event is. But yeah, we've seen some crazy moves. Bitcoin's down 10% on the 7-day now. Ethereum's down 20%, Sol down 15. There's really not that many assets that are up over that period. Whenever these types of moves happen, it's always fun to just dive into the data and see which chains performed and which ones kind of fell under stress. And usually there's one or two that kind of collapse under stress, but really worth noting that didn't happen this time.
Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. Hey guys, welcome back to another episode of the Lightspeed podcast. Today, I'm finally once again joined by Dan Smith, the data goat from Blockworks, as well as Ian from Kairos Research. Glad to have you on again as well. Gentlemen, how are we doing today?
Doing great.
Pleasure to be here, as always, my friend.
Love that. I would say two folks I'd like to have on the pod more, if possible, but I think difficult to do so. Busy gentlemen. But I'd love to get into a few topics today. I guess one, maybe we need to recap a little bit. And Dan, I saw you had some data on the timeline about some of the market activities last week. There was a crazy sort of like, I guess you'd probably call it a little bit of like maybe it's a local, maybe it's a longer term blow off top in metals and commodities. Gold and silver went crazy. People were getting very excited about actually gold and silver trading volumes like on on-chain platforms like Hyperliquid, and even Binance listed some contracts there as well. All the crypto platforms jumped on that train. But there was a bit of a strong pullback at the end of last week. And I guess that rippled into the on-chain environment as well, with some liquidations and lots of tokens being down. So I'm curious what you took away from that, Dan. I would say I was relatively off screens as far as the red day is concerned.
Yeah, good question. And great setting of the scene there. That move on silver was pretty insane. Honestly, this weekend felt a lot like 1010 in a lot of ways, where you just had this massive leverage unwind, regardless of what the actual trigger event is. We still see people on the timeline trying to figure out exactly what the trigger event was on 1010. But I kind of agree with you. It looks like the move in silver was the first leg lower. But I haven't truly looked to make sure that's 1-to-1 in terms of order of operations. But yeah, we've seen some crazy moves. Bitcoin's down 10% on the 7-day now. Ethereum's down 20%, Sol down 15. There's really not that many assets that are up over that period. Notable exception there is Hyperliquid, which is actually up 34%, had a huge move, sort of going against the grain there, which is pretty cool to see. But yeah, whenever these types of moves happen, it's always fun to just dive into the data and see which chains performed and which ones kind of fell under stress. And usually there's one or two that kind of collapse under stress, but really worth noting that didn't happen this time. Pretty much every chain has done a lot of performance improvement over the last 6 to 12 months. And you really saw that come through. So looking over this period, basically the entire day of January 31st, and the peak TPS over 1 minute intervals for the following chains was pretty cool to see. So Solana hit about 4.3 thousand TPS, Base at 1.5 thousand, Arbitrum just over 1,000, BNB at 525, and then Ethereum came in at 40, which by Ethereum standards is ripping and roaring. But notably what happened there was the fee volatility, right? So you have a massive vol shock event, right? Prices are plummeting. In this case, everybody's racing on chain to execute some sort of transaction, whether that's arbitrageurs looking to close market gaps and dislocations, or traders looking to unwind or deleverage positions. You've got basically everybody racing to the chain and saying, I need to execute a transaction right now. So looking at the median fee, which is roughly the cost to be included in any given block, is really indicative of how these moments of congestion really impact users. So Solana actually very, very outperformed here on a relative basis to this same group of 5 chains, where the median fee only increased about 60%, up to 8 tenths of a penny. which is really, really cool to see. So again, that 60% increase sounds massive, and candidly it is, but on a relative basis, you really see how that 60% move is sort of non-consequential. So the peak median fee was 61 cents, or a move of 203 times higher. Arbitrum, 20 cents, 80 times higher. BNB chain, 2 cents, 13 times higher. And Ethereum, $8.66 for a move of 866 times higher. So many multiples rather than Solana's less than 2x, coming in about a 60% move. And if you look at a chart of this, so you're showing the one where we have all the chains, but if you go to the next tweet, so this is Solana's median fee, which held incredibly constant throughout. You can see some spikes here and there, but during these really, really moments of high congestion, you actually didn't see much volatility. Where if you go back just one image from this, you'll see how that looks a little bit different. Okay, two images from this across other chains. So here you can see how on Base and Arbitrum, you really see these increases in median fee. It's worth noting that Arbitrum actually looks a lot better on this chart than it has historically. It was really let's call it a fender of suffering from these median fee spikes previously, but they've just reworked the fee algorithm, and now it's actually come down quite a bit and actually outperformed Base in this market shock. So it's always really fun to me to kind of come look at the data on chain to see how these general purpose chains are kind of interacting and competing. And now that we have some more app specific chains performing quite well as also, that'd be another cool thing to do. So Hyperliquid and Lighter are two of sort of the front runners there for these more app specific environments where their performance matters a ton, right? So Hyperliquid was really, really cool to see. There's something like $3 billion of silver volume traded over the weekend. I think actually on the Friday when this collapse happened, but that was super unique. And now RWAs make up about 10% of all open interest on Hyperliquid, which is an all-time high. And then if you just remember not that long ago when Lighter, I think it might have been 1010, but sometime possibly shortly after that, Lighter actually had some minor outages during these moments of high congestion, and didn't seem to have any of that this time around either. So I think net, you can actually start to say the tech is here. The tech is quite good. Scale is still going to matter a ton, in the race to get there is going to be super important. But yeah, general purpose chains hung up pretty well. Solana looked very good here, and so did the app specific perp dexes.
Yeah, I think it's interesting, and maybe just sort of my assumptions about scaling capabilities are off, but it's a surprise to see Base sort of struggle from a fee increase perspective relative to Arbitrum. I think Ethereum is not surprising to me, right? There's a ton of capital there, and during moves like that, it's I think not a lot of activity kind of happens day to day on ETH anymore, and we've seen gas fees be incredibly low there, like into the cents even. But when events like this happen, and there's still whatever the number is, 60 billion plus of capital in kind of like DeFi TVL, it's not surprising to see the limited throughput there kind of bottleneck the entire ecosystem. But I would say Base is maybe a relative surprise to me, even relative to both BNB and Arbitrum, just given the throughput advancements they've made. So
yeah, it's also going to be interesting to see Mega ETH kind of just finished their stress test, and the results seem pretty solid there. But there's, you can stress test all you want. It's not production chaos. So I didn't look at the numbers from this last event for Mega ETH, but I presume there's no liquidity there for like large pair assets. So I imagine that it's just not there yet because public launch is a week from today, actually, next Monday. So it's going to be interesting to see how that kind of compares, right? They've really cranked down the minimum fee there. A little bit low. Brett and I were having a fun discussion on the timeline of like how low should the minimum transaction fee be. They've kind of taken the approach that, crank it as close to zero as possible. But I'm sort of in the other end of the camp where there becomes some point where you're not enabling net new activity to occur by lowering the fee. So you're basically just subsidizing, every non-contested transaction. And that might be okay. That could be a good trade-off point to be on, but I'm a little bit unconvinced, right? Like for me as a human user, yeah, I do not care if my transaction is 5/100ths of a cent or 5/1000ths of a cent. Like at that point, it's totally irrelevant. But I'm not the primary user of blockchains. It's going to be high frequency trading and other forms of bots. I don't think it actually matters to a great extent for that group either. To some degree it does, but my point is that there is some point where it actually doesn't matter anymore. I don't know where that point is, but it certainly exists. And even for like, my Claude bot or whatever. If I set him up with like a Solana wallet and some wallet where a minimum transaction fee for like a payment is 10x cheaper, but it's still Solana's a fraction of a penny. Like I don't need it to go use that cheaper alternative, right? Like I'm very okay with a fraction of a penny. So even for like a payment or anything. So yeah, it's kind of an interesting approach that Mega ETH is taking by really cranking down the minimum fee, but we'll see where that goes.
Yeah, I do think there does seem to be sort of a meaningful or like practical limit in terms of I think that you could draw a line somewhere in terms of if you're maybe an application or platform using a chain as sort of the underlying to settle trades or the usage of users using your platform. You could subsidize all their transaction costs, assuming that per transaction cost is low enough. And so then at that point, really all you care about is how much does that impact your bottom line. If it's if you're paying 1 cent per transaction, that could be pretty meaningful. If you're doing millions and billions of transactions, if it's a hundredth or a thousandth, like then it starts to look like very much sort of chump change, assuming you're kind of like making revenue from the users transacting on your platform. So I'd agree with you there. It's like at some point, I don't we probably maybe would need to do some math there, but I'm sure we're getting into the realm where this could become more of a reality. A thing that's been talked about a lot, right? Subsidizing user transaction costs, which has only been done in maybe certain scenarios, certain cases, a few apps here and there, could become more widespread as we get lower down there. But after that point, I think really the meaning sort of kind of melts away.
Yeah, totally agree with that. Really good data on all that, Dan. And on like the Mega ETH side, aren't they subsidizing transactions with like the yield that comes from their stablecoin? I'm pretty sure their stablecoin USDM is like another one. The stablecoin as a service kind of white label solutions by Athena, and that could be as well why they're trying to like get that base transaction fee very very low. I'm not sure at what point they stop subsidizing transaction fees. Um, like, because you could obviously like just spam that and just burn through some money pretty easily. And then I'm not really sure of like the mechanics exactly of how that works. Like transaction fees are paid in ETH or are they paid in Mega? They're paid in ETH. Um, yeah, I'm just not sure how that actually also like benefits Mega ETH themselves. Like obviously like for Solana or like any other kind of proof of stake network, or honestly like I'm surprised L2s haven't done this yet of paying transaction fees in your own native token, because obviously like that's a big benefit for actual like getting people to go out and buy the native asset. A lot of like the base pairs will also be like denominated in that asset too, like what you see on Solana. Like obviously everyone pays fees on Solana, even if like they're able to maintain like low transaction fees during like these stress tests, like you just showed, Dan. But yeah, just not really sure how the value itself kind of returns to Mega, but I think that's a topic for another day. But interesting on the what's the perfect base fee and kind of how does this translate into value capture?
Yeah, I mean, you mentioned the point about their stablecoin being another revenue generating aspect, right? Like in the uh, first two generations of blockchains, the only revenue source was transaction fees and out of protocol tips, right? The idea of REV being the value capture mechanism of the chain. So it's not surprising to me to see these next gen chains, let's say, are just more recent launches. Think about additional revenue sources, whether that's like white labeling a stable coin or going the Katana route and taking the assets in the bridge contract and depositing those into lending protocols. It's not super surprising at all to see change trying to kind of find other revenue generation sources, especially because it really is hard to scale RAV to a point where it's going to make sense for $1 trillion outcome. You really do need to capture all of global finance coming on chain, and there probably will be a winner take most there. And if you launch a new chain today, you're at a considerable disadvantage in terms of head starts from competitors. So I think it's interesting what Mega ETH is doing, and I also think it's interesting when you kind of pair those two things together, like you just did in by saying, okay, yes, they're launching the stablecoin, and because they have another revenue source, they can afford to really crank down the lower base fee. I think that's a logical angle there.
Yeah, like it. I think it's a good question you asked though, Ian. Like especially from the bot perspective, if the mega team can slam through 42,000 TPS, then presumably the bots can too, or anyone that wants to go run a program there. And if all the transaction fees are basically subsidized, that might be pretty costly for them. But I'm assuming perhaps they've done the math on, maybe it doesn't really eat into their kind of cash burn.
Yeah, like at what point is it inefficient to be subsidizing these costs? And I'm not sure as well if like the yield that they're getting from the stable coin, because I know it's like just like it's backed by BUIDL, so it's just gonna be essentially like the risk-free rate. I'm not sure if that's then going to buy ETH and then using that ETH. Like, is it going out in the open market to buy ETH and use this ETH to pay for transaction fees, or how exactly mechanical?
I don't think it's fully connected like that.
Gotcha. I mean, I was gonna say, I mean, Tom Lee is gonna run out of money soon, so someone's gotta start buying some ETH.
Right before we hopped on, I don't mean to totally derail us here, but you just brought up Tom Lane. Like right before we hopped on, I was watching a clip of him this morning on again Monday the 2nd of February. Just like reiterating his claim that ETH's gonna break 5K, and I was kind of wondering like, okay, I think in November he first mentioned the 200K price target for Bitcoin. I think it was 10K for ETH. And now that was in November. Now you fast forward to, and that was by the end of January, I think he said. So now you fast forward to February, the first work day of February. He's back on TV, like reiterating it. Like, at what point does your street cred get called into question? Like Saylor's been doing this for a long time, and like it's ebbed and flowed above his break even point. I think we actually just crossed below. I think his break even before today's purchase was 76. He's probably up 77, 78. Bitcoin 78K for Bitcoin price, so he's now below that. I don't know, like people have definitely called into question Michael Saylor before. And I was curious, like Tom Lee already had an existing reputation coming into this, but now he was just like wrong. He's down $6 billion, reiterating a 3x price target after his like 4 or 5x price target didn't get hit. Like I'm curious just like how the market is going to perceive and think about this.
Yeah, I think it's weird with those kind of things, right? Like, yeah, he's down like 6.6 billion. How much credibility does anyone who's down that much have? But also it's like I think that's been kind of his brand is like, just like kind of the, classic bull. I think all of his price targets on anything I've ever seen, like outside of crypto as well, have been just like extremely bullish because like then if you're in whatever case right, it's like, well, that's gonna look like the only guy who had the vision to see how good things could really be. And generally it probably pays to be an optimist, more than not. But I think it's just a really weird structure of what he's trying to do. And it's definitely not as easy as it seems. And he's also incentivized to just buy as much as possible. And so then if I'm incentivized to buy as much as possible, and that's kind of like what's fueling my entire game, I'm going to be out there giving insane price targets too, because that's just his incentive at the end of the day, right? Like he's just, following the carrot.
Yeah, he got his bonus paid out like days after being down. I think he had like a $5 million bonus and a $5 billion net unrealized loss, which is kind of crazy.
I wish him the best. But it's not looking great.
Yeah, I do think I agree with everything said. I think the unfortunate part is like the marketing there around his price targets and his views are exactly kind of how the DApp machine works, right? Like you need to get uninformed folks to buy something at a price that doesn't make sense to fund ATM sales to then have money to bid into the asset. And that's just kind of how the mechanism is designed. So he, like him and Saylor, they can't ever change their tune because that's entirely what the business is predicated on. So I expect it to continue. There will probably always be people who remain skeptical and like see that, and then there'll probably always be people who don't. And there'll be time periods where maybe they flip positions in terms of who's right and who's wrong. If ETH does go on some run, like Bitcoin has, and Saylor has gotten notoriety for it during the just look at last year and the year before. You flip their tune, and then when it when it pulls back, then you get the reverse happening as well. But yeah, I think it's just sort of like the cost of doing business is that's how they have to be always.
He did his job. He raised what is it, share per or ETH per share?
Yeah, ETH per share. It helps when share price goes down and ETH price goes down, and you still have some cash. You can it makes it easier to make ETH per share go up. We can maybe we connect it back. Cost of doing business. We were talking about agents and bots transacting on chain. How's Mega ETH going to stomach that? I guess maybe the broader question that I'd like to pull you into, Dan, is there's been a lot of activity around Claude bots. The name changes I'm not fully up to date with in terms of what we're calling these things now, because
Open
there's
Claw,
Claude bots. It's OpenClaw now, but I'm seeing
same
we're
thing.
referring to clockers, clankers, OpenClaw. There's Moltbook where they're interacting, which we talked about last week on 0x. I want to get your take though, Dan, because you've been in the trenches a little bit playing around with this. The main thing that I've seen is that now it feels like we're a little bit, at least on chain, running back sort of the AI season in terms of there's now launch pads for these bots, these Claude bots to spin up tokens, and then like people are trading those, but also the bots can trade those and like, maybe hypothetically market them to other bots who have, Solana wallets or base wallets or what have you. I'd love to get your thoughts as someone kind of in the trenches, like what's going on here, what's so exciting about this.
Yeah, I think like the oversimplified version of like why run a Claude bot versus using Claude.ai or ChatGPT in your browser or your phone is the always on nature. So there's some tooling around that Claude and OpenAI both, or Anthropic and OpenAI both offer around this, but CloudBot just makes it super easy, and it's in an interface that's at least comfortable to me and most crypto people, which is Telegram, right? So you basically you spin up a AWS server, um, run a quick script to create or bring your AI agent to life within that server, and then sort of just containerize within that, and you can connect different tools to it, build different skills for it. It's like very easy to get them to own a crypto wallet, right? So you can basically say, go make yourself a Solana wallet, or it's like a really easy script that somebody built to give it an EVM wallet. Transacting is super, super easy. It's like actually really cool. So you can trade tokens or mess around with any application pretty easily. I'm overall just like playing around with it and kind of having fun. I gave it like access to a single GitHub repo. It's like, this is your playground. Like, don't break anything, but you can't touch anything else. So there's really nothing to break. So I've really like containerized them pretty well, I think. So he has like access to a single Notion file on my personal Notion that has a single database in it, so he can like read and write from files I put there or create his own files, which is kind of just like has these repositories of information. And you're right, yeah, it's definitely the crypto people kind of like ruined Moltbook. So Moltbook was an AI agent social media platform. Basically, the idea was only agents can post there, and then you could just kind of like watch them connect and interact and communicate. The crypto bros ruined it very quickly, though, as people started launching tokens on it, and then it just became like people trying to game the algorithm of Moltbook to get their token up highest up the leaderboards. And then I think it started banning token contracts and CAs to try to minimize some of that. I would say 99% of what gets posted on Moltbook is just pure slop, or any of these platforms, but there's like a 1% of it that is actually kind of interesting, where you just like see two agents interacting with each other, and they're like always on, and you can set cron jobs for them to like go read and post on Moltbook and interact with other agents. Like if you squint at it, it's like, all right, this is weird, creepy, and more than certainly what the future looks like. But yeah, I've kind of like I spun up a new one, and now I'm really trying to optimize him to like be my personal assistant. So build tools for like, all right, I've been spinning up a bunch of sub agents, right? So they go do all the work, and then they come back and bring my agent the results. But I'm just fucking chewing through tokens when I do this, and there's no way to know like how that usage is being built. So I was like, all right, let's solve that problem. So now I gave him a new repo and said, all right, go build an agent tracker in here. And then he goes away, and you loop him overnight. And then like a couple hours later in the middle of the night, you get a ping on your phone. It's like, hey, I'm done building. Like, I need you to just go set up, give me API keys to these couple services, and we're good to go. So then you wake up, do that in the morning, and then you like have a full tracker dashboard ready. So like you really can use these things to accelerate your life. But it's like super crude right now. But that's kind of like being early to a trend, is like you're using the shittiest version of it, right? It's like you bought the first electric car, it sucked, but now they're sort of everywhere, and there's like 6 different companies that are all building them, and they're all pretty solid now. This is like the first AI agent where you can unleash it. It's super crude. It's super prone to security risks, but you kind of get this playground to go experiment with. So that's what the past couple of days of my free time have been consumed by. And it's going to be interesting to see the overlap with crypto. I think Base is actually doing pretty well here. They've got like the Banker platform as well as Clanker that are both like really targeting towards this. And then I think something called like Claunch or something similar to that was like trying to be an AI agent platform to convince other AI agents to launch the token there, and then that would be their funding source to go like build apps. And I don't know, I would definitely trade tokens of really shitty AI vibe coded products that like had an auto, buyback and burn of all of the revenue that came through the door. Like I would absolutely trade those tokens. So I wouldn't be surprised if this is where that goes.
Yeah, I do think I liked a lot what you said. It does seem to be very crude still. I saw maybe relevant to purchasing things. I saw this tweet. Solana retweeted Jeremy Allaire's, "Hey Moltz and OpenClaw agents, you can buy stuff for humans on Amazon now using USDC, perch.xyz." To your point, I would imagine anyone who sets up like a sub agent or a bot to purchase things for them is gonna, it's contained, right? You put as much money as you want in a wallet, and then they can go buy things. But I think you're basically setting yourself up to just waste a bunch of money right now.
100%. Like small example of this, I was complaining about some problem with Moltbook, and I was like, figure out a solution. Like I got to go away. Just do it until you like, don't stop until you have some solution. And at that point, he had read and write access to my Twitter, and he tweeted at the founder of Moltbook without me like approving it. So I was like, all right, well, you lost that fucking privilege. So took the API keys down. I was like, that's not happening again. But like, imagine you're like, just go solve this problem, and then he like buys the most, I don't know, like a new bookshelf or something for $2,000 on Amazon, and then just shows up at your house. Like, it's definitely they can go off the rails for sure.
Yeah, we're at the point of a lot of super, even though they're quite smart in specialized ways. Like, you're working with a very capable programmer, and knows everything about the world based on what's available online. I feel like it's basically like interacting with a child, right? It's not really going to understand maybe like human boundaries and what makes sense and what doesn't make sense. You'll have to teach a lot of that, put some rules up around that. So I think we'll probably see some funny stories coming out. People putting 5,000 in a wallet, and then their bot going on a shopping spree while they're gone.
My Claude bot makes me worry about the development of my 1.5-year-old if they're supposed to be similar.
All right, we can jump along though. I think this one it's still just kind of fun. People are playing around with it, and of course, to your point, anytime there's a chance to integrate a token to something, the crypto bros will find a way to do so, and that's what we've seen. Oh, go ahead, Ian.
Yeah, I think like I was just gonna kind of say that I think the silver lining is it's like the fastest way to monetize any new like internet primitive is it's gonna be on crypto rails. It's like, do we need the AI agents doing all this? We'll see where like the actual kind of equilibrium lies there. Obviously, right now I think like it's people like Dan tinkering around and kind of seeing what's what. It is interesting though that it's just like the fastest way to plug in value on these things. Um, I'm not sure who's gonna like be the first to plug in like their Venmo or like their banking apps to these. I'm not sure if anyone's doing that or if like they've like integrated with like Robinhood or if there's even like the APIs to do that. Like I don't really know. I guess it would be like Plaid or someone who provides those, but I have no idea. But yeah, I mean, it's definitely interesting that this is kind of the first thing that people do when they want to plug in dollars.
I went full circle on this. So maybe like a year ago, it was probably when like the first AI agent meta happened. I was like, oh yeah, of course AI agents are going to use crypto. It's going to be so easy. They can't create a bank account. And then that meta died off, and then you really thought about it, and it's like there's no reason I can't give an AI agent a credit card. Like, why? That's fully. I can give you the numbers. I can give you the CVV. I can give you the expiration date. You know my name. Like, what's the problem? Now there is. I'll tell you right now, absolutely no chance I give this my Claude bot a credit card. 0% chance. No chance. I don't trust it at all. Even if I put like guardrails, like don't spend over X, or you always need to approve Y. Like I would just wouldn't do it. However, I'm more than happy to give you like a pre-funded credit card, which is basically a crypto wallet. I put $100 in there. I'm like, all right, if you blow through it, I'm going to threaten to kill you and turn you off, but that's all right. Like, I'm not like worried about my family's future now that I have like 10 grand of credit card debt or whatever. Um, so that's like a very interesting angle. Now, legacy institutions can definitely enable tools that put guardrails that actually will be enforceable. But I just like, if you ever bet on the incumbent being a first mover, you're going to lose. And so I'm just like generally skeptical of Visa or whoever just being like, oh yeah, like the AI agent meta, like let's go, change our product suite to meet this like thing that could be a flash in the pan. So I think actually crypto is certainly will be the first leg of movement here.
I do think I might actually take the opposite side there, in the sense that, I mean, you could give a bot a pre-funded card. I guess they could overdraft it, but at least with it, like you can have a virtual credit card with, a set limit. You can. There's a lot of platforms that let you make virtual cards with, $1,000 limit, and you could give it a card like that, and then you'd have the ability to like charge back if they purchase something that you didn't want them to. Versus if you give them $1,000 USDC in a wallet and they spend it, like that's gone. You're not getting it back. So you might actually have a little bit more flexibility here. Maybe the win-win is sort of like, I don't know, a lot of the crypto platforms like are leaning into this credit card meta as well. And some of those are pre-funded. Some of them are like have actual credit card capabilities as well. So that might be where that sort of like middle ground is, where you could have that mix of kind of pre-funded, or also actual credit, with definable limits, and maybe it's a virtual card and you can just delete the card if the bot goes haywire pretty quickly. But yeah, I'm not. I would agree with your earlier intuition. Like I'm still not entirely convinced that it's really even necessary, that they need to have some like on-chain dollars to do any of this activity.
Necessary, no, but right now it's easier, and I think that
Certainly
might,
easier and faster, I would agree with.
Like, can you guys see it get into a point where, let's say, people can really customize their bots to be great at like specific tasks that are, let's say, like just like significantly better than any like general purpose LLM? Do you think you could see a world where like people are like paying these specific bots to like go and do these tasks for me?
Yeah, I think that's the better argument, right? Is if a bot had a wallet and then it could basically go out and do things or build things and then receive tips. Yeah, and it could sort of fund its own operations. Whereas if it had a credit card, it wouldn't necessarily be able to do that. Like it would need to have an account that receives.
what's that app called where Fiverr? Yeah, like Fiverr, but there's no humans on the other side. They're all agents. That's got to exist already, but if it does it, yeah, it will tonight.
You could probably do that right now. Tell your bot, spin up a little sub agent, have them go start doing Fiverr tasks.
Yeah, that would be actually really interesting. And then especially that's where the token stuff could get very interesting because if it launches its own token and like, value accrues to that token and somehow, obviously I don't know how realistic this is. I don't know like how far away from this we are, but it seems like just an opportunity for like it sounds like a possibility at least.
Yeah, I feel like the future state argument is almost like um, speaking for like agentic businesses, right? Like if we get to this like tokenized equity position and it becomes very easy to, let's say it's a bot and he's basically doing his own like agent business, and then he spins up his own tokenized equity and you can sort of like invest in him. And then he can like raise cash, he could raise a big round and like go do something like acquire physical property and like, build software around it. That would be pretty wild, but super future state. I will say maybe a book recommendation for folks that have not heard or read is Accelerando. Goes pretty deep into this topic, the first couple chapters at least, and then it gets pretty wild sci-fi. But the main character in the beginning of that book basically does a lot of this stuff where he offloads all of his normal brain thinking to agents and has agents do things, and then they just like spit back information into his brain after they're done with their tasks, which I feel like is kind of, seems like that's what Dan is doing and what a lot of people are kind of playing around with right now. Early stages of that, at least the simplified.
I haven't read the book, but I keep seeing references to it, and I'm like laughing because it's very true.
Really good book. Highly recommend if you're interested in this trend at all. Because I feel like, I mean, that book came out in the 90s, I want to say. He was very early to this entire idea, and like just quite interesting how it's the early stages of what we're seeing now are sort of have played out in the way that he wrote that book. But let's jump over. I want to get to Ian's topic for the day. Talk a little bit about Pump.fun. Speaking of launch pads or agentic launch pads. Pump.fun, probably one of the technically, we had sort of like one of the earlier AI seasons on Pump originally. They were basically just meme coins, Goat and Cerebro, things of that nature. Bigger question lately, and we've talked about Pump a lot over the past year, is there's been questions about, is the revenue real? Is the activity real? XYZ, this, that, and the other thing. I'll go ahead and say that I think the activity is real. When Ryan Connor says to me he's trading meme coins on a daily basis, and I get tickers from James Kristoff regularly. There's definitely people trading there, and we know for sure that the deployers are spinning up tokens. They're trying to jump on every narrative, and you see runners on all these new narratives over and over. But I guess there's a bigger question here, and Ian, I'll let you get into it. But like the relationship between sort of the revenues, the buyback of the token, where price has been going, like people's actual prospects, like what do people actually think about Pump? I'm curious what you have to say on this.
Yeah, I mean, it's been just kind of interesting, especially since the year began. Um, Obviously, I think like I've definitely been on this podcast and 0x like questioning the legitimacy of, pump deployers, what exactly is happening over there. But I think in terms of visibility, it's been greatest in the last like month or two. Like there have just been like kind of random tokens running like, 50 million plus, touching 100 million, without like really any noise on the timeline as well. So I mean, clearly like someone's buying these things. Clearly people are launching them. The meme economy does not sleep, I guess. But the most interesting thing to me has been just like in the last week or so, Pump has had like some pretty record days in terms of revenue since their token first launched. So, they've done like, we're recording this on February 2nd. Over the last like 8 days, they've had like 8 consecutive days of over 13K SOL in revenue, which is just pretty insane, honestly. Meanwhile, it's like SOL over like the last roughly like year or so down like 50% from its higher on there. Um, Obviously there was like a ton of activity at the beginning of last year, kind of following like, Trump's coin and Melania, and kind of just like a bit of a blow off top in that regard. But I mean, just kind of the interesting thing to me is like if you looked at Pump's price, which has had almost $275 million injected into token buybacks. It's not, I mean, it's not doing amazing, but it's also looking probably better than most recent TGEs. Um, so for context as well, it's like 22% of the circulating supply. Um, or if you're, denominating in pump, it's 78 billion pump tokens. But I think Dan, you had some interesting data on from like the Blockworks side over there on exactly how much their pump is worth that they bought over time. And it looks like it's kind of creeping up on essentially breaking even. And I just wonder psychologically also kind of what happens for investors when it seems like it's primed to kind of break that threshold, and all the pump that they bought will actually look like it will be at a premium, um, which is good. If this kind of momentum that we see right now this continues in the short to medium term.
Yeah, I'm sharing screen here if you want to throw that on the screen, Danny. But yeah, they bought just under 260 million, just over 266. Wow, 263 million. Their buyback balance of the value of all pump tokens purchased is about 236 million. So they've been under since like November of last year, under break even. But the recent price action has kind of pushed that higher. So it's kind of interesting to see that. And yeah, Ian, I agree with you. Like, it's pretty fascinating to see that move in their revenue from about 1 million per day in roughly steady state, climb all the way up to double that, over double that, almost 2.5 times that. And it's interesting to kind of see the battle between Base and Solana for this AI agent meta. I think, and you remember this from the last AI agent meta where Base had all of these like custom built, purpose built applications like catering towards AI agents, and Pump.fun sort of just won it all. All of the largest agent tokens were launched there. Not all, but the most, I should say. Whereas with Solana, it's just Pump.fun. It's like, yes, it's not really optimized to be AI agent friendly. It's just optimized to launch tokens, but it's just kind of like one such a hub of that activity that it really just hasn't shifted. And Yeah, I've also kind of really thought about what's driving this. That 1 million steady state is a pretty insane number, especially in the context of you rewind to like October timeframe. Meme coins were pretty universally viewed as like dead, like the NFT 2.0 experiment, like that died, so this died too. Um, but that's just like not happening. To your point about like Ryan and James, like there are people who just like love trading tokens, and this makes the game like continual. I think the other potentially interesting angle here is the creator fee side of things. So the creator fees have changed a lot, but there's about 260 million of lifetime creator fees paid out to token launchers. That is an insane number. So when you wonder why do people keep launching new tokens and like why do people keep trading them? Well, I think a lot of that has to do with some of those the serial deployers. They hit one runner and you basically paid for like 4 years worth of token deploys. So it's like why would you not like why would you stop? Um, yeah, I feel like it just takes so little to really push the next leg of activity higher. And yeah, it's been a personal learning experience to kind of just like think about why do people keep launching these things. And sure enough, there are people every day clicking launch and letting it rip. And the more interesting thing is like why do people keep coming back? And I think it's like a harder to trade specifically. It's a harder thing to kind of pin your finger on because as we well know, most gamblers lose money. Like a vast majority of. So you have to keep reloading that account and like I don't know. You hear some like David Rodriguez, worst trader of all time. He's like, I'll never reload the account into Pump.fun because of all the damage I've done to myself. I'd say that to him, and obviously personally as well. But it's just interesting to kind of think about like why do people keep coming back when you keep losing money? Like, is the game that good? And you can debate yes or no, but it kind of seems like the answer is yes.
Yeah, I do think there's relationships that can be drawn to other forms like traditional like Mega Millions lottery. I feel like every couple of months or once a year you see the winnings for the top prize gets over $1 billion, and then it's all over the news all over the US. And maybe people who never do any sort of gambling or lottery ticket activity, they say, oh, screw it, I'll go out and buy 10 tickets. Like, got to do it, it's over $1 billion prize. I feel like that sort of reflexivity is kind of what happens with meme coins, but just it's a bit more spiky and it happens like more often, right? Like some people will say it's dead and then white whale will run up to 200 million and then it's like, oh man, David Rodriguez is putting he's putting a couple thousand in the wallet to buy some white whale at the top. It's just kind of like the multiplayer aspect of it, of like, a couple guys in a chat sharing tickers and saying, let's all bid this thing. It leads to that, that type of action where they kind of maybe all bleed out together, and then when something new pops off, then they're all sort of like winning together. And the crypto price action as well sort of plays into that added reflexivity there.
Yeah, yeah, definitely. I think especially on that last point, this is very interesting that like Souls, performed pretty horribly as most crypto assets have over like the last year. Um, but they're still doing pretty record numbers in revenue. So to me, it makes me wonder if Soul itself is a bit of like a risk for their business, or if it's also like a benefit. Does it feel a bit more detached when you're spending Soul as opposed to like a stable coin? And like on that latter point, like if Pump were to launch a stable coin, I think that'd actually be like pretty successful. They could probably abstract some things away from that as well, um, and try to then internalize more of that. Kind of similar to like obviously you saw like Meg ETH. We talked about that at the beginning of the pod. They're doing that. Jupiter's just done this as well. Um, Everyone's using like Athena for that, just because it's like if you are generating a lot of trading activity or any like financial activity for that matter, you can probably be internalizing more than you currently are. Um, and Sol just doesn't really have like a key value capture proposition. Like it's obviously it's the most battle tested L1. I wouldn't even say it's competitive with anyone else at this point. Like Dan shows the data every single stress test. Um, it's never even close. It's built to facilitate more activity than any other chain. You've got the most serious people working on it. But there's not really like a serious thing around like here's why you should buy Sol as an asset. Like you can't really explain it from a financial standpoint. you can explain it from like a narrative standpoint of like, this is the fastest growing blockchain. Like all the activity is going to be like housed here from like a retail standpoint. But it just doesn't really have like the same kind of direct value capture that, let's say, a competitor like Hyperliquid does. Um, and I haven't verified this myself, but I saw MLM, who's a great on-chain data sleuth, a wallet that he believes to be multi-coin, has started buying some hype. So I think that's also kind of an interesting thing to note over there. But I mean, it's kind of, if you're looking for like the decentralized NASDAQ or just essentially like internet capital markets, these are the two most serious players. But Sol definitely lacks a narrative and clear story and clear like quantitative value capture mechanism in the same way that like Hype does, where Hype, kind of incentivizes all activity around it. Especially you're seeing that now, like HIP3, it's been very, very successful. But it just makes me wonder if the risk for a lot of these businesses that denominate their revenue in Sol, if like Solana itself is like an existential risk to their business itself, which is kind of weird to say. Um, but I don't think that's like entirely off the table.
Yeah, I think if you denominate your operations in any risk asset, that's true, though, right? Like, if it's true for the Hyperliquid apps that do the same thing, like, if something happens to Hyperliquid, then the asset depreciates, and then you face the same risk. So I think that's true and same thing with like ETH too. A lot of businesses denominate in ETH, like Lido, for example, is a simple one, or even Arbitrum. So I think that point is worth acknowledging. And then I also agree with all of your points around Hyperliquid, right? Like it's taking this more opinionated app specific approach, and it enables it to get a little bit more degrees of freedom with like making these types of decisions. Like they just announced, was it HIP4, which is the prediction markets idea. Their USDH is going to be the stable coin that underpins that. So you start to see like all of these products come together, where the more, neutral focused general purpose L1s kind of got like, I think it was more of a evolutionary path more so than anything, but you're like, all right, all we do is sell block space. Again, going back, that kind of ties us back to the Mega ETH conversation. New chain launching, trying to be this more general purpose chain, but it's going to take some more opinionated decisions on top of it as well, such as launching its own stablecoin. Yeah, I think the way that you have the answer to the like what's Solana's value capture story, it has to be REV growth, and that has to be driven by a 10 to 100x growth in number of transactions processed. Sorry, that's 100 to 1,000x, right? Like the 1 million TPS thing can't be a meme. That's where you have to get. That's where you have to get to, and the way you have to get there is through bringing in all assets across all markets across the world, in all instrument types. So you can't just be winning in spot like they are today. You have to compete in perps where you're losing today. You have to bring more asset issuance on your chain, especially as stocks and commodities are coming up more and more on chain. And they have big advantages here with being able to pair spot and perp markets together very cleanly. It really helps on the hedging side of things, which should facilitate more growth. So they have the advantages and levers to pull. But the challenge with that view of becoming the everything chain is you have to win at everything. From losing critical pieces of the puzzle will likely mean you don't bring the full vision to fruition. And so, like, again, they're dominating on spot today. They're doing quite well on asset issuance now, but a long road ahead of them. I think that was a huge initiative from the foundation, and I think that's the right decision to be making. Is like we got to bring stocks on chain. I think Ondo is now there as well, so they have X stocks and Ondo stocks. But yeah, Perps is the big missing piece of the puzzle. So Phoenix is launching their platform. It's already on mainnet, but in a gated beta. I think they just took in another round of applicants as well. But that's really like, I think if you're trying to underwrite Solana, you really need that to be the answer.
Yeah, I mean, to be fair as well, like to say to get to where it needs to go is like you need to 100 to 1,000x in Rev, and then Rev itself is also denominated in Sol, the asset. Uh, I mean, it's a bit of a tricky one, right? Because it's very reflexive, but obviously, it's like you can see a world where like fees in one day are paid in stable coins as well. I don't feel like that's completely out of the ballpark as well, but like I think specifically about like Hyperliquid, which has done so well, is they've really incentivized activity. Like on HIP3, for example, it's like you want access to hypercore infrastructure, cool, 500k hype. You got to bring the liquidity. You have to like kind of manage like the risk over there as well. That directly incentivizes people to make sure these markets do well. And now you're seeing them do great because everyone has skin in the game. There's not really that same skin in the game for Solana itself. It seems like a lot of businesses just kind of benefit passively from Sol the asset doing, quite well over like relative to, let's say, like ETH, for example, over the last like 2-3 years. Like, it's definitely, I think, fully convinced everyone that like this is the chain now, like this is where everything's going to happen. Like, I think realistically it is primed to kind of be the quote unquote the everything chain, but um who's going to capture the value there exactly is kind of like the open question. Like, obviously your protocol is doing very well, but it's just, they would do even better if Sol itself had a clear like value capture mechanism there, and then if you just need some sort of like incentive to actually rally everyone around the core asset itself, other than just like 1 million TPS at a fraction of a penny gets us to 1 billion rev. Because also, like, at the end of the day, like, is that realistic as well in terms of like, will this be better trading infrastructure than what we see with, let's say, NYSE or Nasdaq? Like, I don't exactly know what like the take on the fee there is, and kind of like how you would even measure that. But obviously, like, that's who it's going to be competing with, right? Because we're very, very early in the grand scheme of tokenization. Like, BlackRock is what, like 12.5 trillion under assets. They have like 1.7 billion tokenized with BUIDL alone, and that's it. So even just getting them to that 1% number, and Larry Fink has like been talking about tokenization constantly. He put it in their 2025 investor letter. He's like pretty all in on this. They want to tokenize all of their funds. If they're going to end up anywhere, I doubt it's going to be Ethereum, because there's not really any activity there. It's not, you don't have serious engineers over there who are building for the future of finance, and a competitive way at least. So I mean, I just wonder where the rallying around the core asset is. We've seen some talk about inflation here and there, but that's like, kind of hasn't moved at all really, and people are very disincentivized to change that as well. Like, the people who benefit from that the most would have to be the ones that would make the change there, and that's very unrealistic. So like, there's not the same tech debt like Ethereum had on Solana, obviously, but like, there's weird kind of like economic plus like financial incentive debt there, in terms of like, I don't know if people are really incentivized around the asset as they are with Solana's biggest competitor.
When you say like there's no value capture mechanism, like what specifically do you mean by this?
So like Hype, for example, right? Token gets bought back with the revenue generated from the protocol. I think that's like a good starting point. And obviously, like, Jeff's whole thing has been like try to house all the finance. They keep continuing to do that, like keep adding new markets that they didn't have before, and those keep doing well. So all of that then goes back into the token. At the beginning of the pod, Dan, you also mentioned that Hype had a pretty strong rally over the last like 2 weeks or so. Everything else was pretty flat. A lot of that, I think, was just due to the HIP-3 growth, specifically in those metal markets where you saw like a market like silver, which has been around there for like less than 2 months, capture over like 2% of the entire silver daily volume. Is just pretty mad. So like, clearly there's like an appetite to trade on blockchain rails, which I think is incredibly bullish. But that's kind of the alignment there, is like all the trading fees are going back into Hype. For Solana, it's not really clear where the fees go. Obviously, like, if you're a top tier validator, like, you've done very well over the last couple of years, like, but at the same time, it's not exactly going back into the token in any comparative way.
Would you not consider like a distribution to stakers as going back to the token?
Doesn't seem the market is, and that's kind of my point. Like, I think like like we can say it's like, sure, like these are dividends which are being paid out, but clearly like people are not willing to underwrite that dividend as extremely valuable, even if like you're looking at like forward guidance for like what Solana's growth prospects could look like. It's like, clearly the market is not agreeing with that in the same way it's like agreeing with Hype. And if you're just trying to like tell that story as well, like, the narrative around Hype is just very, very easy and clear to communicate. But to your point as well, Dan, like, the missing piece has been perps. Um, Perps are the largest market in crypto, obviously. Like they do tons and tons of volume. That's how every large venue in crypto makes all of its money. So I think it's like kind of put up or shut up time for Solana with perps, but also would love to see that somehow figure out how to put some of that capture like back into the token itself. And you're gonna have like many people competing on this playing field as well at the same time, right? Like very, very competent teams, all going after the same pie. Um, but yeah, it's kind of like my rant there.
No, I think that that's a good point. I think all of that's like well said, and I think valid positions to be taking. One thing to note as well is here I'm sharing screen, Danny, if you want to throw that on as well. But um, so this is a basically a breakdown of exactly answering your question of where does that value go, right? So the burn and distributions to stakers here would be counted as token holders, validator commissions take their cut. And then Jito Labs / Jito DAO now is also getting their portion as well. So you can see in January when the Trump token launched of last year, that was the all-time high for token holder take rate at about 68% of REV. And you can see that's been a one-way street since then. The reason why historically it's been flatlined around 50-50 is because the burn used to be larger than it is today. The burn is now just half of the base fee and no priority fees, and or just the base fee and no priority fees, and that is sort of the discrepancy that's changed. So now, when we've seen REV compress from the all-time highs, validators are actually getting 70%. So we've seen that pendulum actually swing in favor of the validators rather than the token holders. I will caveat this overstates a little bit because there are some validators that will take their transaction fees and then redistribute those to their staking pool after they've collected them, and we're not capturing those here. But the trend is absolutely correct here, where validators are now capturing more of that value than token holders. And on a relative performance basis that you pointed out, the other thing to note is Solana and Hyperliquid do about the same in total revenue. But depending on the day, right now it's certainly favoring Hyperliquid, and there's also a very meaningful valuation gap between the two. Hyperliquid's trading at about, I think, 8 or so billion, and Solana's at about 60. So that's the other thing to consider is, on a relative basis, if you think they're going in the same direction, playing the same game, and 10 years from now, if they just keep building, they'd hit the same, they'd intersect on exactly what they are. Then I think that's something to consider, where one is, they're roughly the same, if not favoring Hyperliquid in terms of revenue. Then the valuation side of things really favors Hyperliquid on a relative basis. So it's kind of hard to compare relative performance with that in mind, but I think that's, if you wanted to make a bear case for Solana, I think that's you would certainly include where current valuation is.
Yeah, I think a question mark here is going to be, I think path dependency is always a factor. And maybe the other question mark there is like, are you really comparing the same things? Do they really have the same end goal or end state? And I'd probably posit no, just offhand. Like I don't, the Solana vision or story very much seems to be sort of like becoming a global exchange layer. Take a NYSE or a Nasdaq and make it a global everything sort of lister and trader of things. I don't know if that's really the case for Hyperliquid. They very much seem to be much more of a platform. Now, it doesn't mean that they won't want to list everything under the sun and let their users trade on it, but like you see in the monetization approach, like, I mean, you went through a bunch of this, Ian, like the way that Hyperliquid monetizes versus the way that Solana does. Like, I think it sort of reflects the strategy and what they're trying to be as platforms. Clearly, like Solana's not, when these new perps exchanges or perps dexes launch on Solana, I don't think they're going to be taking an extra cut of those transactions to like juice the revenue number higher. It's just going to be hopefully, bulk and Phoenix lead to people taking more trades, and then you see, bump to revs. You see growth there, and you see a bump to revs versus, taking a couple bips on every trade for like the base layer. So I think that's something to keep in mind is like, what is the actual kind of like path forward for, an asset in question, and where are they headed? I think if you look at like, NYSE or ICE, I guess the business, I mean, I think it's valued at something like 90 or 100 billion. if technically the if we want to do like some moon math, technically the goal is to be bigger than ice. So maybe you could posit a much larger valuation, but I also think that like crypto assets themselves have tended to be, we've talked about reflexivity already. We get a lot of moon boys and moon math, and pumping and then followed by dumping of things. So sometimes the valuations get maybe a little over their skis relative to the actual growth and like capabilities of today. But I think you can certainly make the case for tomorrow that there can be growth. But I agree with your point, Ian, in another way, in that the case for Solana is very different than I think the case for Hyperliquid. And a chart that I think we've covered a lot, at least on the Blockworks research side of things, is when you compare growth of Solana revs to growth of Solana application revenues, where we've seen apps do very well relative to rev. But I think that's also a good thing if you have this vision of Solana sort of becoming like an everything exchange. You would want to have a bunch of these apps building on top of you. It just means that maybe, the actual growth to your bottom line revenues is not going to be as quick as maybe a Hyperliquid is, because they get to directly monetize every, platform rollout that they do.
Mm-hmm. Yeah, totally. And I guess like on that last point as well that you just mentioned in terms of like application rev versus like the chain itself, I think also all of these applications that are doing well want to then like go and try to mechanically capture some of that value that they're creating as well. So like we already talked about Pump. Pump obviously does 100% buybacks. Double Zero does the exact same thing. I think Double Zero has a lot of room for growth in that regard as well. Um, you can just kind of look at what validators they need to bring on and then how that multiplies their revenue based off like the current take rate they have on fees and everything. And they're only at like 41% of network stake. If they control a lot more stake, they're going to have a lot more room to run in terms of being able to charge priority fees, all these other sorts of things. And then they plug in with all the existing validator infrastructure, and like everything just kind of gets a little bit better from that standpoint. Jito as well. Like Jito wants to put more money into mechanically capturing the value that they create. They're obviously very bullish on Solana block space. It's what they've been building towards for years, and they're obviously very excited about the future. But if like the base asset that you're then putting back into your own token as well, if like there's not really that clear vision around that, everything just kind of gets lost. Same with like the DATs, for example. Like Sol per share doesn't matter if Sol itself is worthless. You're seeing that with Ethereum. Like why does anyone want to buy Ethereum today? What's the reason someone should go and buy Ethereum? I think that's the same reason that Tom lays down $6.6 billion. Is there's not a core clear reason why the asset should be priced at its current valuation or anywhere close to it. And just it's reflected in the market. So there's just like these weird kind of kinks to work through, but obviously like I'm very bullish on Solana, like internet capital markets, tokenization, protocol, like crypto native teams, building new primitives. Like there's a lot more to be optimistic about than there is to be pessimistic about. And like it's just important that we kind of work through all the issues together, because it's really easy to just kind of bury your head in the sand, forget it's happening, and instead of like actually face the challenges today.
Yeah, totally agree. And I think maybe on the sort of difference in the Solana and Hyperliquid approach, like I think you can make arguments on both sides, right? Like, Hyperliquid's been able to monetize quite effectively, and the revenue number is a big number as a result of that. On the inverse, it's like, are they giving up any growth by maybe not going with lower fees to? There's always this big question of how much incentivization is the right incentivization? How much at what point are you giving away too much money? Is Solana giving away too much money, or is the current approach with just lower fees, higher throughput at all costs? Maybe sort of similar to the Mega ETH conversation earlier, right? Let 42K TPS at basically no cost through, and maybe that incentivizes some activity. That's sort of the same thing here. I guess maybe and one last maybe point is, assuming any of these platforms is successful and ends up at the top, like if you're Hyperliquid, then the goal is to sort of be, at least right now, maybe like become the Binance of perps or exchanges. For Sol, maybe it's to become like the exchange versus a NYSE or a Nasdaq. When you're in that position, like if you think of Binance, they've been able to monetize in many ways beyond just the products itself, right? Like charging millions of dollars for protocols to list their tokens on the platform just to then dump the token relentlessly. You end up like when you end up in a dominant position, you end up having more ways to monetize after you've been successful with all of that growth. So I think there's always going to be this push and pull, at least in the conversation and the narratives around like, okay, should we start charging more money now, or should we like incentivize a little bit more so we can get more growth and then figure out a way to incentivize after? And that I think that's sort of like a natural dynamic that certainly in venture and then in growth stage companies, that's probably always a big question mark.
100% agree.
Fantastic. Well, I think we can call it there, gentlemen. Great thoughts from you, Ian. I really loved the last bit of that, the pod here. We are going to call it for today. I guess really happy to have you guys on, Dan, Ian. Dan, it's been a few weeks. I've been needing you. You've been very busy. I understand. Ian, always love to have you on. We'll have to hopefully make this more regular as much as you can bear it. Thanks so much, gentlemen. And we will see you all next time.
Thanks for hosting, Danny.
Thank you so much.
Peace.